IND AS 20, Accounting for Government Grants and Disclosure of Government Assistance. Hello and welcome to Candymentor. In this session, we'll dive into IND AS 20, the accounting standard that deals with government grants and assistance. By the end of this lesson, you'll understand how to identify what counts as a government grant, when and how to recognize it, how to present it in your books of accounts, what to do if you need to refund it, and finally, how to disclose it clearly in your financial statements. So let's start from the very beginning. Objective and purpose. The purpose of IND AS 20 is simple: to bring consistency and transparency in how companies account for government help. Think of it like this. Two companies may both receive a subsidy from the government. Without a common rule, one might treat it as income immediately, while the other spreads it over time. That makes financial statements hard to compare. This standard ensures everyone follows the same logic. Recognize grant income over the period of the related cost or benefit. It also prevents income smoothing. That's when companies manipulate timing to make profits look steady. In short, be transparent, be consistent, and match the grant income with the expense or asset it relates to. Scope and coverage. IND AS 20 applies to almost every type of government assistance you can think of: cash subsidies, export incentives, duty drawbacks, and capital subsidies. It also covers non-monetary assets like free land, machinery, or concessional loans. But a few things are excluded. If the government acts like an owner or shareholder, say by investing equity, that's not covered. Tax-related benefits are handled under IND AS 12, the tax standard. And any broad policy support, like free infrastructure that can't be valued reliably, is also excluded. So remember, if the benefit can be measured in money and is conditional, it probably falls under IND AS 20. Key definitions. Let's get the key terms clear. A government grant is assistance that involves a transfer of resources, usually cash or assets, given to an entity for meeting specific conditions. For example, the government gives you 10 lakh rupees if you employ 100 workers. Government assistance, on the other hand, is a broader term. It includes any help from the government, even if no money changes hands, like free training, guarantees, or advisory support. Then we have conditions and restrictions. A condition means you must perform something, like exporting a certain quantity. A restriction means you must not do something, like using land only for research and development. Keep those distinctions clear. They affect when and how you recognize the grant. Recognition principles. Here's the golden rule. Recognize a government grant only when there is reasonable assurance that two things are true. First, that your company will meet the attached conditions. And second, that the grant will actually be received. Now, reasonable assurance doesn't mean absolute certainty. It means you have strong evidence, maybe a proven track record, clear eligibility, or formal government confirmation. You don't recognize it merely because cash arrived in your account. You assess whether you've complied or will comply with the terms. This prevents premature recognition and ensures grant income reflects real performance, not just timing. Types of grants. We classify government grants into three main categories. A. Revenue-related grants. These are tied to income or expenses, like export incentives, wage subsidies, or duty drawbacks. They appear in your profit and loss statement either as other income or as a deduction from the related expense. For example, a wage subsidy might directly reduce employee cost. B. Capital-related grants. These relate to acquiring or constructing long-term assets. Say machinery or buildings. Here, you can either record the grant as deferred income or deduct it from the asset cost. C. Non-monetary grants. These occur when the government gives assets, like land or equipment, at little or no cost. You record such assets at fair value or at a nominal value if fair value can't be measured. Each type follows the same matching idea: income over benefit period. And matching principle. This principle is the heart of the standard. It says, recognize the grant income over the same period as the related cost or benefit. Imagine you receive a grant of 10 lakh rupees to buy a machine that lasts 5 years. You shouldn't record all 10 lakh as income today. Instead, you spread it, 2 lakh each year, matching it with the depreciation of that machine. That keeps profits realistic and avoids misleading spikes. Grants related to income. Treatment. Income-related grants show up in the profit and loss account. You can show them in 2 ways. Option 1, as other income in a separate line. Option 2, as a deduction from the related expense. For example, if you receive a payroll subsidy, you might reduce your employee cost. If you receive an export incentive, it can appear as other operating income. Both are fine, but once you choose a method, stay consistent. Auditors love consistency. Other. Grants related to assets. Treatment. Now let's look at grants that help you buy or build assets. You have 2 acceptable presentation methods. Method 1, deferred income. You record the grant as a liability called deferred income. Then, every year, you transfer a portion to the profit and loss account, aligning with depreciation. Method 2, net off method. You directly reduce the asset's cost by the grant amount. Then, depreciation is charged on this reduced cost. Both methods lead to the same total effect over time, but the presentation differs. Whichever you choose, disclose it clearly in your notes to accounts. Non-monetary government grants. Sometimes the government gives assets instead of cash. Say, free land to set up a factory. If you can estimate its fair value, record both the land and an equal grant value in your books. If the fair value isn't measurable, use a nominal amount, usually 1 rupee, to acknowledge the benefit. After that, apply the same recognition rules as with monetary grants. Match income with asset life. Refund of a government grant. Refunds happen when conditions are not met. Maybe you didn't employ as many people as promised. If it's an income-related grant, reverse the income or record an expense for the refund amount. If it's an asset-related grant, the treatment depends on your earlier method. If you used the deferred income method, reduce the deferred income balance. If you used the net-off method, increase the asset's carrying amount and adjust depreciation going forward. Always disclose the reason and financial impact of the refund. Presentation in financial statements. Presentation must be clean and consistent. Income-related grants appear in the profit and loss statement. Asset-related grants appear in the balance sheet, either as deferred income or as reduced asset cost. Avoid switching methods between years unless there's a solid reason. Consistency helps users compare performance accurately. Disclosure requirements. Disclosures bring transparency, and transparency builds trust. You must state the accounting policy you've used for recognizing grants. You must explain the nature and extent of grants recognized during the year. If any conditions remain unfulfilled, mention them, along with possible contingencies or refund obligations. Disclose enough so that readers can judge how government help has affected your financial results. Government assistance, non-grant. Not all government support involves grants. Sometimes it's indirect, like low-interest loans, loan guarantees, or technical training. Even if you can't put a number on it, a qualitative disclosure is required. For example, the government provided free research facilities valued at approximately 2 crore rupees. That ensures users understand the full scope of assistance, not just the cash part. Common real-life examples. Let's connect this with real situations. A manufacturing company may receive a capital subsidy under the Make in India program. A small business might enjoy an interest subvention, meaning part of its loan interest is paid by the government. Exporters often get duty drawback or other export incentives. Some firms get energy efficiency grants to cut carbon emissions. Others benefit from skill development schemes linked to job creation. These are all covered under IND AS 20, provided they're measurable and conditional. Audit and compliance focus areas. Auditors look closely at a few key things. First, the eligibility documentation and evidence that conditions are met. Second, the timing of recognition. No recognizing income too early. Third, the matching between grant income and related costs. Fourth, the presence of refund clauses, which may need provisions under IND AS 37. And finally, proper valuation of non-monetary assets, if any. So, keep your paperwork tight and your logic consistent. Interaction with other IND AS standards. IND AS 20 doesn't stand alone. It interacts with several other standards. With IND AS 16, it connects on asset grants and depreciation. With IND AS 12, it separates tax incentives. With IND AS 37, it links to provisions and possible refunds. And with IND AS 23, it interacts when a grant affects borrowing costs. Always cross-reference these when you prepare financial statements. Thank you. Journal entries, stepwise. Let's see how entries flow in practice. A. When the grant becomes receivable. Debit government grant receivable. Credit deferred income or credit grant income, depending on the type. B. When the grant is actually received. Debit bank. Credit government grant receivable. C. When you recognize income over time. Debit deferred income. Credit other income. D. If a refund occurs, debit expense or deferred income. Credit bank or payable. Always ensure narration clearly states the purpose. For example, being grant amortized for the year. ... Numerical illustration. Let's apply numbers. You buy machinery for 50 lakh rupees. You receive a 10 lakh grant linked to that machine. Its useful life is 5 years. Deferred income method. You record the full machinery cost of 50 lakh. Then, record a liability of 10 lakh as deferred income. Each year, you recognize 2 lakh from deferred income as other income. Net off method. You reduce the machinery cost. Record it at 40 lakh. Then depreciate 40 lakh over 5 years, giving 8 lakh depreciation per year. Different presentation, same economic outcome. Comparison with IAS 20. IND AS 20 is almost identical to IAS 20, the international standard under IFRS. The main differences are minor. IND AS 20 adds more detailed disclosure guidance and keeps the term reasonable assurance. So if you understand one, you can easily follow the other. Closing summary. Let's wrap it up. Government grants should be recognized only when there's reasonable assurance of compliance and receipt. Grant income must be matched with the period of related cost or asset use. Choose your presentation method, deferred income or net off, and apply it consistently. Disclose clearly the nature, extent, and conditions of every grant. And remember, a grant is not free money. It comes with obligations, timelines, and disclosure duties. Handled properly, it builds your credibility with auditors, investors, and regulators. Final takeaway. IND AS 20 helps ensure that government assistance doesn't distort true performance. When applied with discipline, it makes your financial statements more reliable and professional, a hallmark of world-class reporting.